Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Taking a look at Genius Sports, Q4 earnings are out and they're pretty good. Stock is up 10.5% in the past 5 days, up about 35% in the past 6 months. A lot of volatility here, but given the volatility in the stock market recently, when you look at the last month's performance, stock is up 5.7%. That's not too bad considering what's going on in the market. You're certainly seeing a worrisome trend with volatility, with tariffs seemingly sticking around for a long period of time that drives investors to believe that, hey, there's going to be some pain ahead, and Genius Sports is certainly weathering that pain relatively well. This, along with Sports Radar, which is sort of in the same business, is one of my top 10 holdings. Sports Radar is there as well. I've done a video on both before, so I will link those down below if you want to learn more about the company. High level, this is a company that buys data rights from sports leagues, think the NFL, and sells those official data rights to bookmakers like FanDuel, like DraftKings. They get a cut of every bet placed because those companies want to use those official data rights. Beyond that, they also work with sports leagues and the teams within for integrity services, for other sports techs. They also work with bookmakers for a variety of services, streaming technology, etc. And they also work with media companies for streaming technology, for advertising. And they were developing this business that's kind of all-encompassing in the sports/sports betting realm. And the thing I like about that is obviously there's a lot of variety there and people are never going to stop liking sports. On top of that, the gambling space is relatively recession proof. So if you feel like some of the stuff happening right now with tariffs, with layoffs in the government sector, etc., is a problem, is going to lead to a slowdown in the economy, a recession maybe, then this is an investment you could look at as something that might do better during a time like that. I'm not saying it's not going to drop at all because everything will drop during a recession, but there might be opportunities here to acquire at a reasonable price, especially if revenue keeps growing as fast as it's been growing. As a shareholder, I was pretty happy with these earnings. 38% growth for Q4, 24% growth for the full year. So revenue growth actually accelerating year over year, up from 21% in 23. Adjusted EBITDA growing 171% in Q4, 61% for the full year. Margins are expanding. That's really the key with this business. The nice thing about this business is that they sign long-term deals with the sports leagues. So let's say they sign a contract that's $700 million across 7 years. It's $100 million in year one, where their revenue from that league might be $100 million. That means zero margin in that first year. However, in year two, it's $100 million. If your revenue goes up 20%, that's a lot more margin. Year three, $100 million. If your revenue goes up 20% on top of that, that's a lot more margin. So by year seven, the margin expansion can be pretty significant. And yes, they have to renew the deal and probably put some pressure on the margins after that. But at the end of the day, this is a company that's going to see margin expansions for years to come since they signed a good portion of their deals already for a longer period of time. They do have some renewals coming up in the next couple of years that will put some pressure on the margins, but they're guiding for significant margin expansion. And the nice thing about this business is in 2024, they flipped the switch, moved into free cash flow positivity. You can see the operating activities generating $82 million in cash in 2024 versus $15 million in 2023, a sign of that margin expansion. They're ending the year with $135 million in cash on the books, a $9 million increase over the past year. On top of that, they did a secondary offering in January of 25 to raise another $144 million. That is a bit of dilution. One thing that worries me about this company is the dilution coming from stock-based compensation, coming from some of these additional offerings, coming from the unvested warrants that are out there and the vested warrants that are out there that I'll talk about in a second. But end of day, they're raising this money for a purpose, and it'll be interesting to see what they use it for. They talked about some opportunistic M&A. They feel like if there is a bit of a recession, a bit of a slowdown, some of the smaller companies in this space may struggle a bit, and they may be able to acquire a lot of these smaller companies that could be cash accretive at a reasonable price. And that's why they wanted to raise this money, to have the flexibility on their balance sheet to do whatever they will. On top of that, and the reason for the high growth in Q4, they signed some new deals with some key sports books where they actually got better terms, which was really good to see. One of the worries about this business has always been, well, why do the sports books need them? Why can't they just use somebody else, or why can't they just use non-official data rights? Well, first of all, they want to use official data rights. The NFL will kind of frown if they don't. And on top of that, companies like Genius Sports, companies like Sports Radar offer a bunch of additional services, and that's showing up in the terms that they're getting from these new contracts. So net revenue retention, for the top 10 US sportsbooks was 163%. So that's really impressive. Net revenue retention shows that they're getting more favorable terms, that gambling in general is growing, and also that they're selling additional services to these companies. And then more importantly, their guidance for 2025 was really, really awesome. The expectations from the market was about 15% growth. And these guys are typically conservative in their guidance, showing revenue growth at 21% for 2025, adjusted EBITDA growing at 46%, which is going to lead to increased cash flow for the full year of 2025. They already have that nice balance sheet. They have a capital allocation framework here that they're showing for the first time where, hey, we're going to continue to reinvest in our business, but we can also make M&A to further strengthen our competitive advantage, to move into other areas, adjacent areas in the business. So when you look at this business right now, it's certainly growing at a good clip already. It's got a lot of interesting areas, but they have $250 million in cash on the books with no debt. They can do something interesting with it and kind of develop, make their business more scalable, increase their global footprint, move into other areas, expand across the sports ecosystem, and just be a bigger part of that sports ecosystem. That's why I invest in this stock. It's like, hey, if you want to invest in something that benefits from people betting, that benefits from sports becoming more popular, Genius Sports is certainly something to invest in. And the valuation isn't all that crazy right now because one, this isn't a company that's well known. And two, it's also a company that's outside of the United States. And sometimes the valuation for these international companies have been lower than they should be. If this company was in the US, this company would trade at a multiple of what it is today, honestly. And you can kind of see this over here showing that, hey, we're accelerating the dollar-based revenue as a company between 24 and 23 from our top 10 US customer, from our top 25 customers, from all customers as well. It's the pricing uplift from those new contracts that we signed, increased utilization of content, additional media products, value enhancing betting, increased in-play gaming revenue. And that's really important because the way this company makes money is if people place a bet prior to a game, they get maybe 1 to 1.5% of the gross gaming revenue or the net gaming revenue, whatever the contract may stipulate. However, if they place in-play bets, that's when the game is happening and you're sort of betting who the next touchdown scorer is or something like that, they get anywhere from 4 to 5% of that. And that's a big difference. And in the international space, the in-play betting makes up maybe 50 to 60% of overall bets, depending on the sport. In the US right now, it's only 30%. So there's going to be a lot of growth opportunity there for this company with in-play betting. They've got a bunch of tech things that they've got going, like BetVision, where they're really driving people to place more in-play bets. And on top of that, they're really driving people to bet more in general, and they're showing the success of that. This is something that they basically offer to the sports books where they can have an streaming service within the DraftKings app or the FanDuel app or whatever, where people can watch certain games on it. Probably games that are local to you anyway, and you can just watch the game on the app and place bets within the app, and that's kind of neat. And also they have a variety of other services that they offer, whether it's technology, whether it's distribution, whether it's advertising, whatever, but you can sort of see the examples here. If you watch the NFL Madden cast on Peacock, that was a Genius Sports offering. If you watch the Datacast telecast on Max, that was a Genius Sports offering. If you've ever seen RomoVision, that's a Genius Sports offering. A bunch of these augmented feed things that they've got going that are really driving interesting experiences for consumers and obviously making a better media product for the companies that are offering it. You can kind of see the growth here where it's coming from. Betting, obviously, still a major portion of this business. And this is going to continue growing as in-play growing expands, as they sign those new deals that give them pricing uplift, as the market in the US expands. For example, as the market worldwide expands, Brazil just came online for 2025. That's going to be a driver of future growth. Missouri's coming online towards the latter part of 2025. What about California and Texas in the future? What about other countries? The nice thing about Genius Sports is that they offer data rights to the sports books. So if the sports books are moving into a new state or a new country, or whatever, those companies are the ones spending money to advertise to consumers, and Genius Sports just benefits from it. There's no real additional cost to them. It's just a benefit when new states come online, when new countries come online. They just have to sign deals with new sports books if those sports books are in those different countries and move on from there. They have a bunch of those media services offerings that's still growing in the double digits. Their sports technology is growing in the single digits for the full year, but 47% growth for Q4. Media was down a bit for Q4, but still growing at a decent clip. And this is really the interesting part of this business. It's not just sports data rights anymore. This media business has doubled since 2022. This sports business is growing at a decent clip and accelerating in Q4. And this is why you're seeing accelerating growth in 24 and guidance for additional 20% plus growth in 25. And I think that guidance, generally their guidance has been conservative. So I'm hopeful as a shareholder that this year is the same and you see bigger growth than 20% in 2025 as well. So what are the negatives and what's the right valuation here? Disclaimer, this video is purely for informational, educational, and entertainment purposes only. It is not investment advice. So you've got a $2.26 billion market cap company, $250 million in cash or so, with an enterprise value of about $2 billion, a 0.82% free cash flow yield, which again, kind of aggressive, but the company is growing in the 20% plus range. You've got that positive free cash flow, but you have to remember that EPS is still negative. So when the market looks at this, they see a company that's growing, but still technically losing money after stock-based compensation and all of that stuff. So this 18.5 million is nice, but that does include 54 million in stock-based compensation, so about 2.5% of potential future dilution. Speaking of future dilution, when the de-SPAC happened, they issued a bunch of stock-based compensation. You're talking about 19.3 million in unvested RSUs and PSUs that are going to dilute shareholders further if they hit certain price points. So again, if this stock is trading at $20 and there's some dilution, I won't be too unhappy about that given that it's trading at $9 right now. However, there's also real dilution here in the fact that the NFL, when they signed their first deal, got 18.5 million warrants that they can use. They can pay a cent for each warrant to change that into a share. So that's about 8% in additional dilution that's out there. So when I look at this company, when I have this buyback number, it's very negative because I want to account for the potential of the NFL actually exercising those warrants, diluting shareholders, and potentially selling those shares on the open market. That happened not too long ago in the form of sales that another of their former owners, Apex Partner, did, which I think was a good thing for shareholders in the long run. They owned about 20% of the company in the past, and they essentially did a secondary offering to sell their shares on the open market, and that put pressure on the price of the stock for quite some time until all those sales were done. And now you're sort of emerging as a company that doesn't have that overhang, which is good for future investors, but still has this overhang of the NFL vested warrant. So it might be nice to say, hey, the NFL owns part of this company. They have a vested interest in this company doing well. So when it comes to negotiate the contract in the future with the NFL will likely renew with Genius, and that may be true, but it's also an overhang in the sense that they can exercise those warrants and sell them in the future. And then you've got the stock-based compensation. So when you look at the buyback yield here, it's quite negative because of all that stuff, the stock-based compensation, the potential for dilution. And sure, in the future, they could start buying back shares to offset some of that, and they will eventually, but I'm not accounting for that right now. Then as we're looking at growth here, I think growth here is going to be pretty impressive for the next 5 years or so. I've got 21% growth in 25, which again, I think could be low given their history of being conservative. Then they also kind of hinted at 26 being a similar year already. So I'm taking that back a little bit, but growing at 17%, 14% in 27, down to 10% by 29. And then you've got margin improvement from 6.5 to 15% by 29. When you look at a more mature business, Sports Radar, which I also own, they're in that like low teens range already and they're in the $1 billion revenue range. So they're a more mature business. I think Genius Sports can, get into that 15% range. Maybe not as quickly as here, but that's kind of their long-term goal. Really, their long-term goal is 25 to 30% EBITDA margins, which I think would be very impressive. And if they can convert, 60% of that into cash, which I think is their long-term goal as well, that's a 20% free cash flow margin. So there's potentially upside from here. And if you think about 20% cash flow margins, then this business becomes really impressive. From a valuation perspective, I'm putting 100% into a 4% free cash flow yield. I think right now this business is undervalued because it's not a US based business, it's international, it's in the UK. And really, that could be a benefit because some money may start shifting from the US to the UK as some of these economic problems and tariff issues and boycotts of the US become realistic and realized. And if that happens, a company like Genius Sports could benefit. But really, for a company growing at 20% down into the low to mid teens by the latter part of this period, a 4% free cash flow yield valuation seems to be very reasonable. I think it could be even conservative. So that gets me to a return of about 11%. But then you've got that negative buyback yield. So that gets me to a total return after that buyback yield of about 8.6%. You can always play around with these numbers if you'd like. Hit file, make a copy. There will be a link to this file down below. So as I look at this, trading at 972 today, I get a fair value of about 914 at a 10% target return. And I think these numbers are reasonable. It's hard to predict free cash flow margins, maybe a tad aggressive here, maybe a tad conservative here, maybe a tad conservative on these buybacks, assuming that the NFL takes their warrants and exercises them. The main risk you have with this company is the NFL deal when that comes for renewal, which I think is somewhere around 28. How much is that going to cost them? Will they renew it easily, or will that put pressure on future margins? Because margins will grow until then. They just signed a football data code deal, which is their second biggest partner, just recently as well. So that's going to be out there for quite some time. And then as these deals come up for negotiation towards the latter part of the decade, how much margin pressures are going to be, and how much do they make up on the sports tech side, on the media side, because they're certainly developing their advertising business right now. Will that do well? There's this potential upside that comes from those side businesses that isn't really shown here. Yes, those are going to grow, but that advertising business in the sports landscape, if they do well on that front, could be massive, could be a very impressive margin expander, revenue expander. A lot of upside here from these numbers in my mind. That's why I like this company. But I already own a bunch of this. This is a huge holding for me. I was buying this in the $2 to $7 range. So if I wanted to add more, like I get why people are adding now. I get why people like this stock now. If I was a new shareholder to this, would I be interested in buying today? Sure. But since I already have a large position, I'd probably need something like 730 to get a 15% target return, 25% off of where it is today, which is crazy to think about. But the market is very volatile right now. There's a bunch of stuff happening in the market. There's a lot of pressure, both in the US and eventually I think that's going to carry through internationally. Because when you think about this tariff stuff, and you think about the layoffs that the US is doing, and it's like, well, this is going to hurt the US, sure. But if the US is hurting, that means they're importing less items from Canada and Mexico and other countries, and those countries will eventually start hurting, and those countries will do poorly and import less from other countries. And it's this cycle of the worldwide economy tanking. And it's not just going to be the US that tanks, it's going to be everything that tanks. If the US tanks, everything tanks. It's not one or the other. That's my perspective on it. I am pretty cash heavy right now as well. I'm kind of in the limit of my investing plan where I have to be 80% invested at all times, but 20% of that could be in cash or cash equivalents. And I'm pretty much at 20% right now because I sold some stuff off in the early part of 2025. Good timing on my part, but at the end of the day, I'm worried about what the market looks like. I'm not putting a ton of money into any individual names. And if this is to be added to, because it's a sizable position already, I think it'd have to be in the $7 to $8 range. Then it'd be really interesting. Right now, it's pretty interesting because if you think about this business, if you think that they can actually hit 20% free cash flow margins, you're talking about 10 to 23% returns, a price in the $15 to $13 range. Even at the 15% margins, you're talking about 3 to 15% returns, a price in the $11 to $20 range. So that's kind of where I sit with this company. Some worries about some of these warrants, some of these RSUs, some worries about a dilution, but they have a nice war chest. If the economy were to tank, this company is positioned pretty well to not be too hurt by it because gambling isn't killed from a revenue standpoint during a recession, but to benefit from it in the way that, hey, if other companies are doing poorly and they need a buyout and they're still cash accretive but being hurt by what's happening in the market, Genius could benefit from that in the long run. In the short run, there could certainly be some pain ahead. The market's going to do what it does. I'm happy holding what I have. It's already a sizable position. I also own Sports Radar, but I wouldn't add more unless there's a bit of a correction here and it gets into the $7 to $8 range. However, I wouldn't be surprised if this kept going up and up and up because this is a good company. The market just has to realize that and get more insight into what this company does and how fast it's growing and how fast margins are expanding. And I think, as you look into 25, there's some potential upside in EPS actually starting to turn positive because they're actually turning the page on that front. Free cash flow is going to be, pretty decent, probably start offsetting, the stock-based compensation maybe being slightly positive after stock-based compensation. And then as you move into 26 and 27, that's when margin expansion really turns the page. And this is a business that starts generating, 100 million plus in free cash flow, and actually, maybe buying back shares and maybe making more acquisitions and then just growing into other adjacent sports areas. And that's what I like about this business. That's what interests me about this business. It's not just the betting data rights business, it's all the other stuff they can do. And now they have the optionality to do that. And they're competing with other players in this space for sure. Sports is there. I like Sports Radar a lot. I actually might like Sports Radar more than Genius Sports. But both of these companies are very interesting and are in a space where they're the two biggest players and they have the optionality to make acquisitions to do whatever they want in this sports adjacent area. So those are my thoughts on Genius. If this is a new company to you, let me know what you think down below. If you already own it or are thinking about buying it, also let me know down below. And as always, like, subscribe, all of that good stuff. And thanks for watching. Bye.